All right. Shocking stats of underperformance is my segment. Every year S&P does, state of active management and how it compares to passive management. And passive management just means owning the S&P 500 and going to the beach for the rest of the year, which is a fantastic, tremendous strategy for a lot of individual people, individual investors. And so year to date, according to the data, they're at 51% of active managers have underperformed the S&P. So it's very 50-50 if you've underperformed or outperformed. But that is not the norm. And it's not the full year yet, so that I'm sure it'll keep skewing from the average. But 2021, 85% of large cap domestic equity funds underperformed. 60 in 2020, 71 in 2019, mid 60s all through the previous 4-ish years, 87% in 2014. And so very, very infrequently, there are years where active managers of large cap domestic equity funds outperform the S&P 500. And many people kind of know these stats. I'm going to go on here now for Canada because they do data based on each region. So I was just talking about the S&P 500. How about Canadian equity funds that outperform, or I guess in this case, underperform the TSX composite, the S&P TSX composite? You were just sharing your thing for the beautiful people on.
Yeah. So they were able to see it, and probably just a quick note is that it was as of June 30th, 2022. So the year to date is for last year. Yeah,
year to date was for last year. Okay.
Yeah.
Well, here we go.
But still, I think very valid, very interesting data nonetheless.
Yeah. Here's some data for Canada. So I got 10 years, 5 years, 3 years, and 1 year. So let's go 1 year, and then we'll work backwards. So in the past year, 51.9% of Canadian funds underperformed the S&P TSX composite. So these are Canadian equity funds. So they're investing in Canadian stocks, and they're being benchmarked to just Canadian stocks. So it's the correct benchmark. So 51.9% underperformed in 1 year. You'll see as we go further and further out the time period, we get more clear underperformance. 3 years, 83.8% underperformed the S&P TSX composite. 5 years, you have 93%. And then 10 years, 84%. So very fascinating. Look how big 5.
Yeah, 5 and 10. So it reverts the trend a little bit.
It reverts the trend a bit. So on a long view, on 10 years, roughly only 15% of Canadian equity funds outperformed their benchmark of the TSX composite. So very shocking kind of stats of underperformance. You and I have been good enough investors, and I would say have the right behavioral psychology to see some pretty wonderful outperformance during these time frames. But it's a reminder that investing is hard, and professional investors often have very difficult incentive structures to perform well. They have to trade a lot. They're answering to clients. They're focused on short-term objectives. And a lot of investors like you and I and many of the people listening to this podcast don't have those same constraints and arbitrary demands to meet that can make beating the market an incredibly hard feat. Just look at the data, right? Like, this isn't just me making it up. That the data shows what the data shows. And so it's a reminder that investing is hard, but it's also a reminder to don't feel like as the little guy, if you are, or maybe you're very wealthy managing your own money, that you are at a disadvantage, because it's just not true. I don't believe that's true at all, especially with the tools available now. Like, you can use Stratosphere, which is a professional equity research terminal for $40 a month. A Bloomberg terminal is 25 grand a year. And so the playing field has massively leveled there as well in terms of the data availability and the tools that are available.
Yeah, definitely. And I mean, I think there's obviously some really good fund managers out there that are able to beat the market. I mean, that 15% that beats it over 10 years is impressive. But it's also just 15%. And I mean, the biggest thing they've had going against them, in my opinion, is I'd be interested in seeing the amount of managers that would beat the index if they didn't have the fees, or if the fees were
Right.
equal to the, index ETF version of, what they're
Interesting point.
comparing the benchmark. Exactly. So I'd be very interested, because it's probably closer to 50-50 across the board or something like that. I don't know. I'm just speculating, but I'd love to see that data, because a lot of
Yeah,
the
before net of
underperformance is
fees.
the
Yeah.
fee. Yeah, exactly.
Yeah, good point, right? Because I'm assuming that's what this data is including, right? They're trying to sell their story on why passive is
Yeah.
great.
Mhm.
I would love to see this data, and maybe it exists somewhere. I'd love
It
to know if it exists
must.
somewhere.
Yeah. We can't be the
No,
first ones to have thought about.
no, no, no. That's not where I was going with this. I'd love to see the data on the difference in performance of these fund managers and how high their portfolio turnover is. Because all of the great equity investors I know, and I follow their 13 Fs, and they've had tremendous performance, has been very, very low portfolio turnover because they've bought winners and held them. That's how you outperform. Like, break it down to its very basic form of outperforming the market. You hold stocks in aggregate that do better than the average. And if you're in and out of stuff, that becomes a lot harder. All the great investors in the 13Fs that I know have massively outperformed the market on a long time horizon have bought right and held tight. That's the only, like, that. I don't see another way to have massive outperformance unless you are some expert level trader. I think that the easy way and the most accessible way here is to buy right and sit tight.
Yeah, I mean, that's what we do for the most part. I think, at the end of the day, I think, as a general philosophy, at least for me, and I think you're like that too, we try and buy and hold businesses for the long term. I think it's fine to, at least for me, I'm still leaving myself some opportunities if I see that something is, in value territory, and it's something like a bit more of a turnaround play that might be a bit more short, medium term. That's fine too, but definitely let's say the foundation of my investing strategy is just to buy and hold some really good companies.